I'm going to get started and introduce our next panel. First off, I'd like to welcome everyone to the 9th Annual Hispanic Heritage Foundation Investors Forum. To those of you who are joining us, we want to take the opportunity to thank our sponsor, TIAA Institute, for their continued support. Up next, we have Preseed to Venture Capital panel. Joining the panel, we have VC investors that will discuss investment trends, capital availability, valuations, and expectations for the coming year. They will share their thoughts about the pre-seed market. Moderating the panel, we have Adrian Mendoza, General Founder and Partner at Mendoza Ventures. Please take it away, Adrian.
I'm excited to moderate this panel. I think there is a collection of friends that I know, new friends that I've met at this panel. I'm really excited when they asked me. I also share the privilege of being an advisor for the HHF Investor Forum. So we're happy to have you guys join, be part of this, and at the same time, get us to meet some amazing diverse emerging managers. And so I want to start off with some intros. I'll go left to right. So I'd like to ask Lisa Feria from Stray Dog Capital to give a little bit about her background, her fund, and her investment thesis.
Happy to. Hi, everybody. My name is Lisa Faria, and I'm the managing partner at Stray Dog Capital. And our focus is early stage food system investments. So we invest in climate-proof food system technologies. So food companies that are driven by either technology or some kind of a IP or patent protection. We have over 46 companies in our portfolio, and we are on our third fund.
I guess Angel may not be, but we'll come back to Angel and talk to Rachel Brink from Red Bike Capital.
Hi, everyone. Great to be here. My name is Rachel Brink. I'm the general partner of Red Bike Capital. We're a early stage fund based in New York, and we invest in companies that improve people's lives and power the economy. In particular, we invest in fintech, e-commerce enablement, SaaS, marketplaces, as well as wellness. Thank you. Great to be here.
Great. We'll go next to Lu Zhang from Fusion Fund.
Thank you very much. Seems like I have some technical issue with the camera, so sorry, seems like it's not showing my face. I will just go audio only. So I'm the Lu Zhang, founder managing partner of Fusion Fund, or the VC firm based in Silicon Valley, focused on deep tech and the healthcare earlier stage investment. So we invest across the United States and also start allocating to Canada. So far, we have 3 funds under management. I just did the final close for my fund 3. Which is a $120 million fund, continue investing seed and Series A.
Great. And I just saw that Angel Gomez is on from Cardinal. So Angel, take it away.
There you go. Thank you so much, Adrian. I want to apologize to the life with a 2-year-old has a lot of unexpected twists and surprises, but I thought I owe it to our audience, the Hispanic Heritage Foundation, and professionals to make it today. So I'm Angel Saad Gomez. I've been a venture partner at Oak Investment Partners for over a decade. And very recently, our team is spinning out to launch One Cardinal Capital, mainly focused in deep tech investments worldwide.
Okay, great. Thank you guys all for joining. And I think I'm going to kick this off, and we have a lot of questions to go over, but I'll keep you guys moving. But the big question that I think is on everyone's mind is that we've seen a significant decline in the public markets. We've seen a decline in the late growth stage, which is the other side of the barbell strategy at IPO. And really, for the 4 of you, how has this affected the impact of your investment thesis and where you see valuations primarily in the stages? Why don't I start off with Rachel?
Sure. I think in terms of our thesis, it doesn't, we're still very consistent and very comfortable with where our thesis is investing in high growth early stage companies. What has changed, and I think it's actually more attractive, is that you are seeing a couple of things. One is valuations have shaved down, and there's definitely a more dramatic effect at the pre-IPO, where you're seeing more like 50% down rounds on the valuations. I think on the seed earlier stage, it's more around 20%. So you are seeing a little bit less crazy valuations. I think a lot more emphasis on multiples and sort of being able to justify your valuations even at the early stage with some reasonable multiples. I think the other side of it is just the market's moving a little slower. And I think for people like us who are very research driven, who are very fundamentals driven, who frankly want to get to know the founders, want to make sure that we're being helpful, that we're investing in companies where we can really partner with the founders and help them scale, that's a good thing. So those are really the two things that we're seeing on our end.
Rachel, being that you invest in enterprise and consumer products, where do you see it from the consumer product side, and where you see it, on that vertical?
So I will say that it's tough all over the place, but I think that the expectations are even higher on the consumer side. I think that whereas there's perhaps a little bit more comfort level on the SaaS side that, okay, if they've had a product, there's a little bit of product fit. If they have a few customers, they'll get many, many more. I think on the consumer side, there is this expectation of, okay, you figured out D2C, but what about omnichannel? What about Amazon? How do you scale beyond your first digital customer? So I would say that it was already happening, but the bar is even higher. And that's, I always joke that my background is on the consumer side, and I was a founder of an e-commerce and subscription business. And I always say I'm probably the toughest, consumer investor because I actually know how hard it is to scale it. So I think everybody else is waking up to that reality as well.
Lisa, same question to you, but also from the food side, where you see it on the food side of that vertical.
Yeah, I'm happy to follow Rachel because so much of what she said is what we're seeing in the food system, but we're seeing a little bit of a two-prong result. So the first part of the two-prong result is a good one because we're early stage investors. And so investing at low valuations is intrinsic to the returns of our fund. And what we saw, and not only at early stage, but just across the pipeline, what we saw is that all kinds of generalist funds were trying all different stages. You got hedge funds coming down. I mean, you just have like a lot of silt in the water with generalist investors trying all kinds of different strategies. And what we're seeing now is that they're parachuting back up. They're like, oh, things are tight. And you probably saw the report on D1 today from Bloomberg. I mean, just in general, I think investors, and particularly generalist investors or hedge funds, are now starting to go back to their lane. And that really helps the overall, particularly early stage, which is where we play. It helps us because then now we can have more paused conversations and due diligence with our investors. We can spend more time building the fundamentals of the business without them like trying to rush headlong into growth stage crazy valuations. Now, the second part of that prong is for our companies that have made it into or in growth stage or are at that stage, they graduated there and either participated in the crazy valuation town or expected to participate in the crazy valuation town. Then now they're really having to reground and say, how do I make sure that I have enough cash, that I have the fundamentals right, that my customer acquisition costs are right, that I'm really thinking about low cost distribution systems. Rachel was just talking about e-commerce. And how are we, as early stage investors, we really normally dedicate a lot of our time in helping build the companies at the earlier stage. But now we're having to expand to cover our older children, if you will, and helping them reground those fundamentals so they're not running out of cash, even in healthy businesses, and that they can get the valuations that they need and that we are also expecting. So it has been a two-prong. It has been great, and also a little bit of a fire alarm of us making sure that our companies are covered and supported.
Great. Lou, same question to you.
Yeah, thank you. Yeah, definitely agree with what Rachel and Lisa mentioned about the general, reset of the valuation, and also in terms of more reasonable period of doing due diligence in the earlier stage. I think for the deep tech and the healthcare sector, the sector we're focusing on, we did not see too much of a pausing in terms of doing new deals. It's still very active market. It's just that both investor and the founder definitely go back to the original range in terms of offer valuation and multiple. Another thing is really, as also Lisa briefly mentioned, the same thing for our sector is really more focused on the fundamental of the business, which is, company also need to have a strong market validation to show the capability of generating sustainable revenue themselves. I mean, like generate blood for themselves in this quite challenging environment right now. In terms of the capital into the earlier stage, I think we still have a lot of dry powder. I remember I saw the data for the Q1, there's still like a $4.8 billion new capital into earlier stage. The true slowdown really happened in the growth and late stage. From my conversation with lots of $1 billion fund focused on growth and late stage, some of them even told me they did 0 deals Q1 this year, and also they intentional slowdown since they're worried about their existing portfolio who got crazy high valuation last year, and this year they need to prioritize their capital to support them. So I think that's also something that really for earlier stage founder need to watch out when they are gonna raise their Series A round, B round in couple months. What is the market dynamic? That's also the reason when we're looking at a company in earlier stage right now, we also want to see whether founder has the right mindset, not just to raise a round, but also prepare themselves for the next round in terms of the runway, in terms of the capital they raise, instead of, for example, only thinking about having 12 months of a runway, minimum at least to think about having 18 months of runway, which contribute both from the capital they raise and also the revenue they could potentially generate. In general, I think it's still, very good market opportunity for us since we've been very disciplined on the valuation. And also as a former entrepreneur myself, I do believe that reasonable valuation at the earlier stage is really long-term beneficial for both sides, both the investor and the founder.
Great. Angel, how about yourself?
Thank you. Yeah, so within our deep tech buckets, we have categories like enterprise SaaS, but IT infrastructure and connectivity pieces. Those historically have had lower volatilities, relatively speaking, in the overall markets, and we're seeing the same. Many of these companies that provide core services, even on the enterprise SaaS side, to these companies, it seems that they are doing fairly well in this economy and project to do fairly well going forward. We're seeing the same things with our earlier stage companies. In fact, some of them their next rounds are getting preempted at pretty healthy valuations, even though we still try to tame down expectations for growth because we intend to be prudent about it. But what I'm hearing overall is that some of the categories where we've been focused, at least the members in the panel, to invest, we're not seeing a lot of this crazy volatility that is reflective of the overall economic sentiment. And I think that is a great value add, particularly to LPs, because they're trying to sort out how do I reduce correlation between our venture asset class or our venture asset exposure to the overall markets. And I think it was last year at this event where we talked about how there was much more underlying correlation between public equities and venture capital because so many folks were pegging onto, high growth tech in the big category, but there are areas within that are still doing quite well. So it'd be interesting to see how it all continued to flush out, but I'm happy to be in company of folks that are thinking about how reducing that exposure to overall market volatility, it's ultimately for the benefit of the LPs.
So looking at the past 6 months, and I'll start with Lisa, have we seen a change in the pre-seed from check sizes to valuations from the beginning year to now? And how are each of your firms adapting to that change?
Yeah, we definitely have seen changes. And the two that I have seen come up more consistently, and it has accelerated. So the beginning of the year, first month and a half, kind of the same as 2021. And then now after that, up until now, June, it has accelerated, which is the trend that the rounds are smaller So they have, really what I think is right size the round. So instead of thinking, hey, I'm going to go gangbusters and I'm going to race around again in 9 months. Now they're thinking, hey, I want just enough money to prove my consumer market fit data and then come back for, already earned money, if that makes sense. And so I think it's much more in tune with what we would expect as investors, where we are investing in chunks of the company's growth at a time, and we're funding them for that spurt of growth. And then once they achieve it, they come back. Whereas before, I was starting to see a lot of seed companies that were coming out to the market straight up raising $8 to $9 million, which in food is a lot. And so now I'm seeing a right sizing of that and an expectation of like, hey, I can't keep coming back to investors a lot shorter timelines if I haven't met my KPIs. And so there's a lot more conversation around, okay, now you're raising a smaller round, but what are your true expectations of growth and what are your KPIs that then you're gonna be able to then come back to me and say, look, here's what I accomplished, is we're right on track where we need to be. It really is about building sustainable, companies that can grow well, right? We want them ideally to IPO or get acquired. So they need to grow at a good clip, but not at a way that they're throwing all their dollars at revenue, even if it's unprofitable. Doesn't matter. This SKU doesn't make money. Let's still get it out there because people want it. As opposed to, hey, we are building the next Unilever. We're building the next, General Mills. How do we make sure that from the get-go we're building a company that will be sustainable? And so it sounds logical because it is logical, but with the craziness in the past 2 years or so on valuations, like they would just kind of rush through the different stages in a hurry to get to that $200 or $300 million valuation in the growth stage and missing a lot of the fundamentals. But because we had so many different generalist funds that would feed that, then they would be able to get that $9-10 million raise and some crazy number of pre-seed and then run off to growth stage without the revenues being there.
Lisa, do you have a couple of examples of both round size matched with valuation? And I think that question of how, as with this new world, what are you guys deploying to in terms of check size?
For sure. So our check sizes vary between $1 million and 2.5. We're usually early to first to second check initially, and then we follow on a few more times. And we usually target to take about, between a third to half of the size at the round that we invest in. And I have a company, I can't mention names obviously, but I had a company who came out last year with an innovative product, but because we're food systems, right? These products, when they come to us, usually they've only been made in somebody's kitchen or a commercial kitchen. They're very early. And so at that stage with that level of risk, maybe a few years ago, we were investing in a company like that at under $10 million for sure. And now in the past 2 years, again, with all these generalist funds and other parachuting in, then those valuations became $30 million out of a product that they just made out of their house that don't have a co-manufacturer yet or don't have any of those building blocks. And now they're coming back with a small $1.5 million raise at a significantly reduced valuation that is consistent to where they are from a growth and proof of concept standpoint. And that's just within a year. They came from, like a really significant decline. Because when they were doing the math and thinking about growth stage, so-and-so company just got at Series A at $200 million. So if I back away from that 2 years, then I should be able to get a $50-60 million valuation at the seed stage.
Interesting. Angel, on your side of the pre-seed, where you're seeing your deals in your spaces, and same question to you, size, valuation, what you're deploying to.
So at the pre-seed level, and even at the seed level, we tend to invest into categories that are still technology-wise, that are still very, very new. We are lucky in a sense that most of these technologies are not well understood by mainstream investors. So technology itself is a very strong barrier to entry from a defensive standpoint to the companies themselves, but it also is to us as investors. And we have insights of having worked with companies in these spaces for decades. So that gives us a little bit of that edge. And many of these the founders themselves already come with significant industry experience. So they will tell you straight off the bat, they are not optimizing for valuation. They are thinking very strategically about what valuation means and all the different offensive and defensive levers that they can use to get talent, to get customers, and to have enough capital and resources to be able to deliver on what they need to test out on many of these technologies that are still very nascent. So from that regard, the only thing that's different is that before they would struggle to raise capital because there were only a set of niche investors who understood the category well, and the expectations and the bar were really high. Nowadays, tons of investors want to throw money at many of these companies. Sometimes, I'm part of the reference calls and with the due diligence, and I find myself having to explain to the investors what the basic concepts of the technology is. And that tells me that, this is frothiness, momentum seeking, particularly with like 5G opportunities, people throwing money at the problem. And trying to find interesting opportunities, but luckily many of these founders, we have a back and forth and we say, look, do you really need that money? It's great to have it, but what additional value are these investors bringing to you? Because if there isn't much beyond the cash, right now, you don't really need it. There may be situations in the future where things become even more, a little bit tighter. In that case, if there's not a lot of money to go around, they'll take the money from whoever. But many of the folks, at least right now, they're being very thoughtful about when do I take the money? Again, many of these cases, they're being preempted as far as the rounds are concerned. That wouldn't happen earlier in many of the categories that we invest in. And then it just depends on the situations of the company itself and the ambitions that it has in terms of going global. Some of these companies and some of these technologies in particular, large multinationals are very interested in being able to close them. Now, being able to capture a large multinational is challenging, takes resources, and you distributed pilots around the world, et cetera. So you have to plan and think for that. Yeah. And you guys are getting
Angel,
to know my son
is
now.
that typical at the pre-seed in that type of vertical to be already talking to multinationals and big corporate strategics?
So I don't know what typical means, at least in my category, when we're thinking about, for example, private 5G networks, it's the multinationals who are the first ones thinking about how do we start leveraging modern day networks to power our factories, or they're thinking about the problems related to data. They're saying, look, we have so many data and so many different silos. We need to think clearly about what is out there to help us solve this problem from a technological basis. So I am seeing that.
Great. Lou, how's your view on the world in the Valley?
Yeah, thank you. I think definitely we saw the reset of the valuation and also the shrink of the round size in deep tech and healthcare earlier stage round. Another thing I think is last year, the contributor to this crazy not only valuation but also round size is also sometimes from the non-traditional VC firms like a hedge fund. For example, like we typically lead the round. I put in typical check size $1 to $3 million. Still the same this year, and typically prefer to lead around. But last year, I was not only competing with other early stage focused firm, I was competing with firms like Andreessen, Tiger, SoftBank for leading around. So I think now. With the market dynamic changing, there will also be much more reasonable capital coming to the earlier stage in terms of the profile. Another thing is because of the reset of the valuation, funders also are thinking about what is the round size really makes sense in terms of still have enough runway and enough growth capital, meanwhile, maintain their ownership, not to have too much of dilution. Another thing, as I mentioned early on, like a company in the deep tech and healthcare sector really want to focusing on the fundamental of the business, which is how to quickly generate market validation, how to quickly generating revenue. So when they're choosing investor in the relative smaller size round, they're really focusing on first whether this investor really understand the technology and the industry. Secondly, whether they could really help the founder in terms of the quickly get go-to-market done and be able to have a sizable contract. And also third, more importantly, is whether this fund has a pro rata large allocation for pro rata
investment, because the first, understanding of the tech industry is important. Deep tech and the healthcare company have a very different life cycle compared with the consumer or e-commerce company. So a firm like us, like I was a material scientist, so that's all my partner, we're all technical founder ourselves. So we're able to better, help founder understand the life cycle of the technology development. And meanwhile, when is the good timing for them to do large scale commercialization. Secondly, it's really about how to do better go-to-market in terms of the market validation. So I set up this network called the CXO network. Now it's the president of the network is one of my new partner, Sheng Wang, who was a former CTO at HP. So when he was at HP, he is a member of the network already. We have this network set up, really want to enable 42 CTO from Global 1000 companies in our network quickly connect with our founders. So after we invest into the company, they will be able to present in front of all this true financial decision maker in the large corporate who are looking for a solution to integrate. So I think that's a really powerful and valuable platform we present to the founder, and the founder would value that more compares only consider the potential valuation. And besides that, another thing is really reserve capital for the following round. When I talk with both my existing founder and also the new founder were plan to invest, we really kind of try to analyze the current situation by two steps. Definitely there's lots of volatility in the public market. And also the first half of this game is really about survive, how company could really survive through the cycle. But on the other side, the second half of the game is really about survivor gonna be the winner. So we talk with founder, also discuss about, the round size and also the runway, how long you need to have the runway, because it won't be ideal for founder to slow down their growth. So we want them to keep their growth ratio, be able to press the gas, still really capture the market opportunity, because if they really survive the cycle, then they will have much less competitor in the market and much more concentrated investor capital coming to them in the later round, and then they will be easily become the major player in the market. So yes, there's a crisis, but also opportunity always came along with crisis.
Hey, Rachel.
I love Lou's point of, yes, there's a crisis, but there's also opportunity. And I think that's definitely what we're seeing. So, in terms of what's going on in the market, there is definitely, we've talked about slowing down investment cycles. We've talked about valuations. But I think the other part, and Lou alluded to it a little bit, is this idea of, a greater focus on go-to-market strategies, a greater focus on creating proof points early on in companies' life cycle to justify these valuations. So for example, we just invested in a fintech that is targeting real estate brokers. And a lot of the reasons we invested in them wasn't only because they were using technology to create a higher LTV customer in this category, but also the fact that they were very thoughtful about their go-to-market strategy. They had one of the larger real estate players actually be an investor in the fund. They were able to sign on 3 large real estate platforms to be partners and help them acquire customers quickly. So I think there's sort of a shift where, founders should be very scrappy and very smart about their funding. But now that they have this realization that, capital may not be flowing as quickly, that this realization that they will need to provide proof points. And again, we're seeing this across fintech, across SaaS, across across the wellness categories that we invest in. There's just a lot more, I think, at the earlier stages, thought being put into that go-to-market strategy of, look, I'm going to have to justify my valuation today, and I'm going to have to justify my valuation in 12 to 18 months. So what are we doing right away to get to those proof points? I think that's an interesting piece I'm really seeing accelerate.
Good. And I think following on that, we've seen with, the changing market conditions. I love how a lot of you guys have referenced to there was an opportunity here. Yet, last week, NASDAQ analysts flagged that the IPO market will probably slow to a standstill, if not a crawl, in the next 3 years post growth round. what are the liquidity options that you guys are seeing in your verticals and in your sectors, and how are they going to affect timelines for LPs of your funds to be able to get returns? Rachel, you can go up.
Sure. So I think that, look, I think we're lucky that we invest in the early stage. So in any case, our companies need time to develop and grow. So first of all, I think that by the time the market comes back, our companies will be in a great place to go into the IPO market. But the other reality that I think is happening is that, again, going back to valuations and entry point, it's very different to come in at the seed stage where you can, if you have a $5 million, $10 million valuation and you have an acquisition with an exit that's 200 million, 400 million, 500 million, great, right? Versus if you're sort of coming in at a valuation where your expectation is that this company needs to hit $10 billion. Well, I think we all kind of know that there are only so many $10 billion companies out there. And so I think that in the stage we're in, I do think we're going to see in the next couple of years, as there is a slowdown in the IPO, there's going to be a little bit of an acceleration in the M&A. Because I do think that there are a lot of companies with a lot of money in their balance sheet that will take this opportunity to acquire strategic companies, startups that will work well for their companies. So again, entry point's important, ownership's important, but it can also be a very nice outcome for our LPs.
Yeah, I'll jump into Angel. Outside of the M&A market, what are you seeing in your spaces? What are other options for liquidity for your both LPs and your fund?
So, I mean, again, I guess one of the privileges of playing in a category of IT infrastructure and connectivity or advanced systems, we're seeing it with some of our companies of our previous portfolio that have gone public. There is significant interest from strategic investors to continue to, now they're becoming investors, whereas before you would say, oh, that's an M&A opportunity. These companies are large enough and valuable enough where the technology and the business case is adjacent enough that it adds strategic value, but not too close that it would make sense for them to acquire directly. And it is those companies that are coming in to continue to fund because they understand the value that these companies bring to the table long-term and the value that it's already being provided to them. So from that regard, we don't rely on the overall market, mainstream market to participate. It's really the key insiders that understand what this value is. And it's not very challenging to find different types of financing, whether it be debt vehicles or whether it is straight equity. So maybe what we're seeing is a diversity of options, whereas before there were too many bidders wanting to offer the most popular type of financing option out there. Now you have a lot of different investors with different bends and interests, but gives you that flexibility to say, okay, which one makes sense based on what we need in the near term? Who is going to be that genuine partner that can give us access to their company or allow us to grow because they have more capital, et cetera. And allows you to align long-term interest in a much more attractive manner, particularly with the companies that are large enough or perhaps even public. That's a whole different ballgame now. Now you got to start getting into shareholders and votes and all that kind of stuff. But the ones that are just about to get there, they also have tons of other backers already. The ones that haven't been public but probably should have been public already. So that doesn't make things any easier. You just now have a bunch of different investors, some of which make decisions quickly and others which don't. So they can really slow down the process. But I think overall it's good. The diversity of capital and the different strategies that this capital has behind it is actually very beneficial. But I think also that's a benefit of the categories that we invest in because they provide a very critical role within the overall technology ecosystem.
Angel, you bring up the point about non-traditional capital, and I'm going to ask the question of all four of you because I know the two answers have been both Rachel and Angel about funding. How do you view the panel right before us was talking about mid-market buyouts, smaller private equity funds? How do you see the role of private equity and the mid-market buyout strategy in the next 3 to 5 years? And additionally, other things like the secondary market, where secondary funds are now becoming to ramp up. I'll ask Lisa and Zhu and Ludo to pipe in on this one and give you guys some your great opinions.
Yeah, what is it that Ben Graham quote? Expect volatility and profit from it. I mean, there is nothing more true at this point in time than that. Some investors, and that also includes some strategic partners, as soon as the economy started slowing down, they kind of ran for the hills, reground, got in the cave, the whole thing. But what I'm seeing is that I think the ones that have planned for the long term, whether it be up or down, and that need to make sure that they're motivating their consumers to continue to go to the shelf and seek their products through innovation and things like that, are continuing to be solid partners. And so I'm very enthused and excited about mid-market buyouts as well as strategic buyouts, just because they need and are very motivated to make sure that consumers are buying their products. The second piece is what I'm seeing a lot of is investors who were trying different categories, but not necessarily experts in that category, are now kind of stepping back, reaching out to us as a fund and saying, we know you guys are the experts. Once it comes to growth stage, call me and I will look at it, as opposed to, kind of doubling here and there for potential secondaries. And so they're really curating, they're interested in the category. They realize they don't have the time, staff, knowledge, et cetera, to really pursue it primarily, but they're open for a smaller basket of proven companies that then they can snatch up on the later stages on a secondary and so forth. And then so those are all push or pull strategies. Those are kind of happening already. Nothing that we're doing. What we're doing as a pull strategy also is, early stage investors. I typically, normally before this year, we had some conversations with different, M&A partners, banks, secondaries, et cetera, but usually we wouldn't really chat with them until later. And it was very much they're reaching out to us because they had a client. Now we are establishing and laying down new roads for more consistent communication. So as the companies are marching towards growing and getting ready for them, they already know what's coming, as opposed to what's hot and what do people think is cool. They really are refining their strategy to make sure that they're picking up and still connected to the hot markets in a way that allows them to be more focused in their approach.
Lou, how about yourself?
Yeah, so agree with what Lisa mentioned. Mid-market buyout is actually also a very good option for some of the potential exit. I think especially for the deep tech and the healthcare sector I'm focusing on. There's also type of company, for example, like cloud infrastructure company. They will be company focused on certain layer of the cloud infrastructure. Maybe certain reason the growth is not ideal. Then for mid-market buyout firm, they could really buy a couple different solution, like a vertical solution, and build a portfolio and make a platform play, and then potentially push a much bigger, market valuation after they build this smaller portfolio, which also is good for company. It's also provide alternative for the shareholder, like investor like us and the founder to have exit. For us, we did not do any secondary exit before. We also did not plan to do any secondary exit. I think another thing is really for the merger acquisition activity in our sector, it's really, really active. Lots of company we invested, it's really, a big pusher, big contributor to the digital transformation across the whole industry, regardless it's industry, automation, to enterprise network, edge computing, cybersecurity, to the healthcare digital transformation. So I think this is also open up opportunity, not only just the traditional merger acquisition buyer who are more like a tech sector, tech company. Lots of the traditional industry player are actively giving merger acquisition offer for the tech startup, be able to integrate them better into their system. For example, as I mentioned, we have this CXO network. I heard a couple CTO from large company like CTO from MasterCard. He recently talked with me. AJ said, okay, the board gave him $1 billion budget, try to buy company focused on cybersecurity and data privacy. And there's also other like P&G has a huge budget for kind of sustainability related technology as well. So I heard out of this new budget from the company, since they really had a challenging time during the COVID. Now It's really not a nice to have for them to integrate technology. It's a must to have. Besides just becoming a customer to a tech company, there's also option for them to just acquire a company. Within healthcare sector, besides the typical, merger acquisition opportunity we always see in the med tech and AI in healthcare sector, another is really pharmaceutical company had lots of cash during the COVID. And now they're also looking at how they could better utilize the data they have and have an internal data strategy. When they have the data strategy, also a better option for them to just acquire AI data company, focus on the pharma industry. And we have companies really benefit from there to have very active and multiple offer on the table for merger acquisition. So last year we have 7 companies exit through merger acquisition. This year alone, only Q1, we already have 3 company exit, and there's more merger acquisition conversation coming up. So for us, we think that's a really positive signal because fundamentally, I really don't think we should have so many company IPO. Some company are good candidates for IPO as a standalone company, but other company will be a better add-on to the existing industry player. When we talk about digital transformation, apply AI, it's really not about disruption or replacement. It's really about the empowerment. I think from that angle, really merger acquisition provide a win-win situation for both industry player and also technology owner. And also because we have so many new buyers in the market, active giving offer right now, we could really help our founder, getting multiple offer and negotiate the best multiple and the price for sale.
Great. Lou, as we look into the next 6 to 9 months with your firm, how do you see the number of pre-seed deals that you will be doing? Are you going to slow down? Are you going to increase? What does that number look like? And then, where do you see the overall market moving in 6 to 9 months?
Yeah. So specifically talk about us, we won't slow down. We did not slow down. We've been super active in investing last year, this year, and also that's a plan for the next half year. I really see a great opportunity because of the reasonable valuation multiple. Another thing is, as I mentioned, this so-called crisis mode really make lots of the potential customer to the company we invested realize the importance of the integrated technology. So the sales cycle is getting better, surprisingly. Another thing we found is we've been monitoring this founder database with lots of serial entrepreneur who did it before. They went through the financial cycle before, and we saw surprisingly lots of this type of founder. They're starting new company because they really see the market opportunity came along. On one side is the matureness of the technology. Technology is really better, faster, cheaper. We're going through this singularity point of having lots of new technology ready for large-scale commercialization, specifically in the deep tech and healthcare sector. I personally super passionate about healthcare. I'm so happy to see so many great founders start to push innovation in the healthcare sector as well. And another thing is really the adoption of the technology, and much less education need to be done for the customer to understand the importance. And so for us, we really see this as a great market timing. And meanwhile, we also really think, in terms of the capital in the market, which is more reasonable and rational. And we were able to using capital as a very effective filter to support the right founder. For example, when we have so much capital in the market, in earlier stage, everyone got funded. Then there's no clear signal about whether this company could raise a round means this is a strong company because everyone got funded. But now I think that's also a very good way to do earlier filtering in terms of leveraging how founder could close the round. And when they continue to grow, that the market dynamic will be much beneficial to them.
Okay, that was a quick one, Lisa. Do you guys, what do you guys see in terms of the next 6 months of number of deals that you guys will do? And are you increasing or slowing down?
We're definitely slowing down, not because we don't expect to hit the number of companies that we are going to deploy capital into, but I think the order might be a little bit different right now because we are supporting some of our portfolio companies that are in the later stage, and we're sort of getting them to a good place so they can continue moving past us. And so we are doing some of that rejiggering right now, and some of the capital that would have gone to all 100% pre-seed, seed, very early companies are now, some of that is going to those Series A to stabilize them, especially obviously the ones that we think are going to do really well, but that maybe got a little over their skis with the funding market. And so I think that's really adjusted the process. However, we're still seeing the same number of entrepreneurs. We're still continuing to do diligence. If we find extraordinary deals, we will go invest. But in terms of the pace of allocation and who gets the capital first, that's changed a little bit.
Great. Angel, how about yourself?
So if we could accelerate our investment pace, we would. So for any of the LPs out there, reach out. But for example, in our case, like my team has been operating since the 1980s. Interest rates were like 14%. Think about every single depression the economy has had since then. We've come out thriving. And the reality is that there's many really interesting companies out there with kernels of technology and IP that is fascinating, but the deck was stacked against them when they decided to take on very large valuations from investors that didn't really appreciate or understand what was happening, and now they're retreating. So what we've done in the past, and what we believe we also can do on a case-by-case basis, is coming to invest at very attractive terms, and not only bring on board some of that intellectual property, but also be able to manage the founding team and the existing engineering teams, which are really good in most cases. But those kinds of transactions can be very emotional, and you really need to think about all the right stakeholders to keep them on board, particularly in the labor market that is so tight. So the general goal is, how do you make it a win-win for everybody at a valuation that is reasonable, so that you can accelerate the pace of innovation within specific categories and companies, so that you can create category leaders at a much, much earlier stage, because you're effectively consolidating the smartest teams in the country or in the world revolving around a specific topic, and then you can create some really interesting jewels. And we've done that on a couple of cases in the past. And I think it's prime, right? Because so many interesting emerging technologies have been developed in the past 3 to 5 years. They were overhyped in terms of what could be done, not really understanding the timelines that were required to bring them to market or to fruition, productizing them of sorts. And many of those existing investors have pulled out, or will be pulling out, or are having difficult conversations with their LP base, trying to figure out, like, what is the direction that we continue to go? Well, we have somewhat of an edge, not only from the experience and the perspective of all the cycles, but because we are really good in those categories that we've been strongest in, and we have that credibility.
You know what, Angel, you bring up a good point, is that the goal of venture capital is building innovation and creating it within your regions. And one of the things that I'll ask both Rachel, Lisa, and Angel, because you're not in Silicon Valley, correct me if I'm, you're all nodding. Okay, you're not all there. I know you guys, all right. How do you view the ecosystem in your local geographies with that creation of innovation, with dollars, with co-investors, and where do you see that changing, with these market conditions and more? Where do you see how you guys play in that space? Angel, why don't you kick it off? Angel, Lisa, Rachel.
Perfect. Happy to. So, by virtue of what we focus on, there are few areas around the world where are really sort of incubating the types of things that we look for. So even though historically we've been Silicon Valley based, our companies have been spread out throughout the world. And the pandemic sort of helped us realize that it didn't really matter where we were. The important thing is that we offered the level of support to our companies and be able to reach out to their potential customers and help them with the business development and strategy piece. And that is too distributed. Not everybody is in Silicon Valley. And in fact, now with people working from home and all that kind of stuff, folks are kind of reassembling anywhere around the world. And when you think about the multinationals, they are already spread out. So from that regard, we're sort of losing our ties to Silicon Valley in the physical sense, and really gaining that reach globally, because now we can be anywhere and we can be distributed. Now, there are some things, for example, the engineering teams, you do need some ecosystem around there to exist. But we've seen so many of those start unraveling around the world as well. So you start finding folks much more attractive quality of life, much more attractive and enduring sort of labor costs aspect, recruiting pieces, et cetera. It's almost like saying that, innovation can only come out of universities in the Silicon Valley when we all know that's not true. So it's a very exciting time that now you're started seeing. And the other cool thing is many of these other geographies have an evolving venture ecosystem that is supporting at the earliest stages some of these companies. In many of what they call a seed round in the United States, you would call an angel round, right? So you can stick to your thesis of doing seed investments or pre-seed or maybe Series A. But once you start looking at some of these particularly foreign ecosystems in Europe, where they invest heavily into R&D and real technology innovation, et cetera, you start seeing very sophisticated technologies come out to do a seed round. Whereas in the United States, generally wouldn't have seen that because the flavor du jour of the last decade has been, very easy to create in hackathons kind of ideas that you then turn into a minimum viable product. And then 1 week later, you start getting funding. Well, that's easily replicable. And we try to stay away from those kinds of opportunities because we were looking for more robust technology. So I'm currently recently arrived in Florida. In Miami, there's a lot of really interesting things happening, but by the nature of the Miami ecosystem, these companies are thinking scale, and they're usually thinking global. Because if you think about just going down the street and knocking on people's doors and saying, "Hey, I'm going to sell your product," you're not going to get very far if you just stay in Miami. So that's always helpful.
Great, Lisa, thoughts?
Yeah, I don't disagree with anything that Angel just said. I think that's pretty similar for us. In the food system, even more so, the majority of food companies are very much all over the United States and all over the world. And they are manufacturing and headquartered all over the place. So you don't really need to be located in a specific area to be successful in the food system, which has really significantly helped these companies make sure that they can keep costs low, as we're talking about making sure that that cash is preserved. It actually has come back to pay off. And the second piece is that I would say that investors outside of Silicon Valley tend to be a little bit more cautious about, and I'm a little bit generalizing here, about valuations. What I've seen is that there is definitely a little bit of a valuation increase as soon as Silicon Valley investors, particularly syndicated groups, start getting involved. And so I really have enjoyed our companies having a variety of different investors from all over, so they can get the benefit of the investor relationship connections in Silicon Valley, but they also have investors that have expertise in other regions of the country, as well as other areas that they need for the company to be successful. So really, it's all over the place, and it will continue to be, to Angel's point, around employees going everywhere. And so you can find talent in a lot more places that you couldn't before. Before it was more localized, and now it really has spread out, and we expect that trend to continue.
Lisa, you're based out of the Midwest, in Kansas specifically. How do you see the localized market in the Midwest? Where do you see it going in the next 6 to 9 months?
That's a great question. So I myself live in Boulder, Colorado, but we do have our headquarters of Straight Up Capital in Kansas. And, I get this question asked all the time. And my main answer, I have two answers, especially for the food system, right? Number one, it keeps us humble because as I think as venture capitalists, you really think about what could be, and, or we're going to change all these people's habits and they're going to start using these products, And I think being where we are really helps us make sure that the products that we're putting out to the market can and will be enticing for Americana, right? It can't be just that it's attractive for people that live in California or something like that. It really needs to be attractive for somebody that lives in Kansas. So the products that we're bringing to market, I use when I lived there, I used to feed it to my neighbors to see if those were things that would apply to their palate, if the price is right. Just really keeps you, I think, as a venture capitalist, with your eyes on the clouds, because you always have to be finding the next thing and the trends before they become trends, but also keeps you grounded, because these are the people that at the end of the day, I need to buy our company's products.
Great. Rachel, on the New York City side.
Yeah, I was going to say, yes, I agree with all of you about distribution of talent, about the opportunities and valuation, but you don't bet against New York. That would be my, I never bet against New York. And, you know, what I'm seeing right now, particularly in fintech, but across the board is, you know, there's such an energy of people coming back to in-person events. I don't know if you guys saw, for example, Y Combinator just announced that they're going back to in-person, not fully, but they're going back to some in-person events. New York City, you know, Adrian, you and I are meeting in a conference next week. So I do feel like there's a huge amount of energy and excitement around being back in person, around meeting in person. And I do find it incredibly advantageous to be in New York. It's just, it's easy to meet founders. A lot of them are here, but even the ones that are not here, you know, come through here. So there is a huge amount of energy in New York City. And I do feel like, you know, New York, if anything, will be more of a hub after all COVID subsides and things sort of settle back in.
Great. Lou, now to you. How have you seen the Valley change, and where do you see the culture, the ecosystem in the Valley changing now with the large super growth funds having a lot of trouble in finding, you know, that large markdowns that are happening in the industry?
Yeah, so I also want to kind of code what Rachel just said. You know, you also don't want to bet against the Silicon Valley. I think first it's really, you know, we're based in Silicon Valley. Actually, we have a pretty healthy breakdown in terms of a company location. We have 60% based in Silicon Valley and 40% outside Silicon Valley, including company based in like Pittsburgh. We have a very good portfolio based in Pittsburgh, in Austin, in Chicago, Salt Lake City. So I think this diversity of the different location base really give us a very good perspective about opportunity in different region, and also be able to capture the opportunity in different region, make sure there's the best practice for the founder. So go back to the question you asked about, you know, what's going on in the Silicon Valley right now. I think lots of traditional billion-dollar fund who used to claim that I won't work, I'll invest a company within 12 hours of driving. Now they're changing. You know, I even know during the COVID, actually even for us, like during the COVID, we only invest in founder we could meet in person, which also kind of limited the location of the founder we could meet with, especially for last year. This year, definitely it's better start to resume travel. I was in East Coast, in Pittsburgh earlier this year. That's also what I saw from larger VC firm. They're all open up, try to invest more diverse background founder. Meanwhile, we also saw more founder. I agree with Rachel, you know, people are really love to come back in person. Yes, Zoom meeting is awesome, but on the other side, there are lots of part of this, you know, subconsciousness connection, trust build up, which could not be replaced by Zoom. In-person meeting really have this dynamic and chemistry for people to connect and understand each other better. And also just a human nature, we're a social animal, and lots of founder and investor love to have in-person engagement. So I also see a group of lots of the founder are coming from other region to Silicon Valley to connect with investor here. For example, Q1, like this year so far, we already host 3 happy hour founder group from different region. Like there's a group from CMU. They have a really strong founder group. They came to Silicon Valley. There's another group from Wharton, from UPenn. There's also another group coming up very soon from Chicago. So this other founder, they're reconnecting with the Silicon Valley VC, and meanwhile be able to really bring the opportunity in their region to the Silicon Valley investor. I think another mindset change and shift for the larger VC in Valley is really think about what is the reasonable multiple and valuation for a different round. I know we talk a lot about, you know, slowing down and the potential down round, and also the challenge in the public market. But on the other side, the reality is actually we still have lots of dry powder in general in the whole VC industry. I know there's data showing that we have like 15% less of the capital came into VC this year compared with last year. But let's remember last year was a landmark year for VC industry, that we never had so much capital into private sector. And this year, yes, it's lower than last year, but still larger VC, they have capital. They may prioritize supporting their existing portfolio. They also are holding the dry powder, wait and see. So I do think that now they're saying, also expecting a more reasonable multiple within the early growth and the late stage. And then later this year, maybe next year when the market is more stable, there will be more active investment deal flow coming out in the valley.
Great. I'll go left to right. I think we're coming up to time. This will be my rapid fire question. I'll start with Rachel. Web3, are you investing in pre-seed Web3 companies?
We're being very cautious. Honestly, I think that if you look at the adoption rate, at least for what we're looking at, it's still early days. It's hard to see who's going to be the winner. So we're looking at it, but we have not invested yet.
Angel.
So Web3 means a lot of things to a lot of people. Start off with that. But if you ask me, are we investing into or looking into decentralized systems, cryptography or cryptographically enabled distributed systems? Then the answer is definitely yes. But when we're thinking about all the other stuff about trying to apply the latest blockchain tool to every problem out there, sometimes it doesn't make sense and you got to be upfront about it. But blockchain has very promising, interesting applications, and we are going to be looking at those as well. But if you just think about Web3 as a broad umbrella, I would say no, other than the specific areas that I just noted.